So that is on the benchmarking. So for any option and any performance that you are measuring, you have an option that I can compare it with my past performance, right? I can compare it with my past performance. This year, this quarter, my inventory turnover was so much. Previous quarter, my inventory turnover was so much. We did better or we didn't do better. I can do past. That is the easiest. Or I start to do internal benchmarking, all right, functional benchmarking, competitor benchmarking, or generic benchmarking. It becomes more and more difficult as I move from my own performance to internal performance benchmarking to let's say competitor benchmarking to functional benchmarking and generic benchmarking. The second aspect of procurement, especially, remember, as a procurement professional, you have two accountabilities. First, you are accountable to the risk associated with the contract. Remember, when you enter into an agreement with a supplier, you're exposing the organization to two risks. All right, you are exposing the organization to two risks. One, the risk associated with the supplier, the risk associated with the supplier. Second, the value of the contract. Let's say you have a contract for maybe, let's say, any category. I'm just taking facilities management. It's $100,000. You award to supplier A. Supplier A. Right. Now, two things are happening. You have an agreement. Two things are happening. One, you are exposed to the risk of this supplier. What if the supplier does not perform? That's a risk, and you are accountable for that risk. You are the one who like I said, please keep your microphone muted and don't write on the, somebody has drawn this blue line. And remember, I cannot erase that blue line. It will remain permanently on the screen. So the person who has drawn that blue line, can you use your eraser to erase that blue line, please? Otherwise, that blue line will remain like this on the slide. So please do not annotate on the slide. All right. If you are annotating, please erase it also once you annotate. Don't leave it like that, because that blue line will keep appearing. If I go to the next slide, it will be there. All right. If I go to another slide, it will still be there. So please do not write on the slide, because I cannot erase it. I can only erase my writing. I cannot.
Sir, I don't think we are allowed to do that.
No, you are allowed. I just removed the right to annotate. So somebody annotated before I removed before I changed the security setup. So please don't do that. And if you have done it, use the eraser to erase. And keep the microphone on mute if you're talking to someone. It's a matter of courtesy to other participants also, right? You disturb others also. So what I was saying, that once you have an agreement with a supplier, you are exposing the organization, your organization, to the risk associated with the supplier, and the value of the contract. If it is $150,000, the value of the contract, you're committing your organization's money to the supplier, right? So it also means that you are accountable for these two activities. You are accountable to the risk, and you are accountable to monitor the spend. The way to monitor the spend is what we call through budget. Right? Budget is used, is a plan in monetary terms. Remember, once you have this $150,000, that's the approved procurement value. You need to get a budget to meet that approved procurement value. And budget is a plan in monetary terms prepared and approved for a defined period of time. In this particular case, for the duration of the contract, because that $150,000 will be for a 2-year contract period. The purpose is that I'm able to control my spend. So every time I pay an invoice, every time, for example, this 150,000 is for a 2-year contract, year 0 to year 2. This is my budgeted cost. Budgeted cost. Every time I pay an invoice, that is my actual cost. That is my actual cost. If my budgeted is maybe divided into month, 24 months, let's say, this is my budgeted cost per month, and I'm paying invoice every month, I need to monitor my actual spend against the budgeted spend. That is the process of measurement of performance related to your budget. In a way, used by the procurement personnel to control the spend of that particular category. Again, remember, in order to get the budget, you need to do a business case with strong justification about the value. Remember, when you say that, oh, this contract will cost us $150,000, management will think twice. You need to prepare a very nice paper and present it on a business case basis to say to the stakeholders, to the management, that, yeah, this is a good spend, right? Good spend. And then you got your budget approved. The second thing is, once I have my budget approved, I need to execute my contract. As I execute my contract, I will spend money because supplier will deliver the goods, he will raise the invoice, I have to pay the invoice. I have to make sure that I control my actual against the budget and make sure that I monitor that. Right? And I monitor that. And whenever the actual is more than the budget or less than the budget, I need to identify the reason why the variance occurred. Right? Why the variance occurred. Let's say it's a purchase of certain items, unit price of whatever, X amount of dollar. Quantity was maybe Q. Quantity was Q. My budget will be X times Q. My actual will also be X times Q. If my actual is equal to budget, everything is fine. But if the actual is more or less than the budget, something has gone wrong. Either there is a variance in the price or there is a variance in the quantity. I need to be able to identify the variance and ensure that the root cause of these variances are identified. Corrective action is taken to bring back the spending on track. Right? Because if I'm spending more than my budgeted, I will run out of the money in the contract before the end of the period. My contract period. If I'm spending less than my budget, it could be that my business requirements have changed, or it could be that I have done a good job of working with the supplier to reduce the cost associated with the purchase. So there might be certain positive reason also. Plan your budget. Plan, do review cycle. Plan your budget. Execute. When you execute, do. As you execute, you monitor the actual against the budget. If there are variances, you take corrective action to bring the variance to normal or to equality, budget equal to actual cost, and review. Maybe you over budgeted, that's why you're underspending, or you under budgeted, that's why you're overspending. Something has happened. Maybe you thought that the price would remain what it is, but the price increased, or the price decreased, or you thought quantity will be so many pieces, maybe the quantity now has increased. PDCA is plan, do, check, review. That is on the quality side. Again, a similar framework, right? You can use plan, do, review. PDCA is generally used for quality issues. You can also do it here. It's part of the plan, do, check, plan, do, review. Same framework. The do will now be divided into do and check. Do and check. Because once you have implemented your corrective action, you need to check and put the recommendation to action. More applicable to it's a Deming cycle, and Deming cycle was used for quality issues. This is not a Deming cycle. Now, how do we do budgeting? Whenever we talk about budgeting, we need to understand what are the cost elements, right? Cost elements, and when do they occur? When do they occur? Right? When do they occur? So your organization is something like this, right? Supplier, organization, customer. Of course, you are in the supply chain, so you have upstream activity, and then you have downstream activity. Upstream, downstream. So let's focus on this one, because this is the immediate, this is your part of the supply chain. You receive raw material, right? You receive raw material, you receive services. You need to pay cash. Right? You need to pay for the goods and services. Then these are processed into finished goods. These are processed into finished goods. You need to pay labor. You need to incur the cost of operation. Cost of operation. You need to pay wages. You have overheads and you have operating cost, right? To convert the raw material into a finished goods. So there is a payment made here. Outflow. The finished goods are stored in inventory. The finished goods are stored in inventory. So there is a cost associated with storage of goods in the inventory. Right? You have labor cost, you have overhead cost for that. Then you sell the goods to the supplier and you receive the money now to cover the costs that you have already incurred. If the money that you get from the customer is more than the cost that you have incurred, then the company has made profit. Then the company has made profit. If the money that you get from the customer is less than the money that you spend in all these operations, then you end up in a loss. We pay the supplier. Remember, if my supply chain is long, I will have to pay the supplier. There'll be cash outflow. I'll have to pay salary to my worker, cash outflow. I'll have to pay for the energy, the lighting, the utilities, the operating material, the maintenance. There will be cash outflow. Then I have to sell. There'll be selling cost. And then I close a deal. I get money from the supplier. That whole process is called cash conversion cycle. This process is cash conversion cycle. Obviously, the efficiency of this cycle is how short is your cash conversion cycle. If my cash conversion cycle is 45 days and my competitor's cash conversion cycle is 40 days, I lose. Right? I lose. So I can benchmark the cash conversion cycle of my operation against. Yeah, Rokhan, I'll come back to that at the end of the. You can ask that question when we close, when we kind of end the session today. Okay. Let's first continue with the flow, otherwise it breaks the flow. The cash conversion cycle, I can benchmark. Right? I can benchmark against my own internal function in other country, other city, or with a competitor, or with some other so-called functional benchmark to tell me whether I'm doing well or not. Shorter the cycle, the better. Even better. Yeah, even better. Shahidul, who would be having a negative cash conversion cycle?
Well, if payment against the procurement is made later than the revenue generating from the customer.
Yeah, so companies like Amazon has a negative 25 days. They make money from the money that you give to them actually. If you compare it with Walmart is also quite well actually, but Walmart is plus 4 days. Plus 4 days minus 25 days. Amazon is way ahead. But way ahead. So cash conversion cycle can be negative. That means you're collecting money first and paying supplier later. So what are the cost and the income entries? Remember, when you receive money, that is revenue, right? When you receive money, that is revenue. Then there are costs that you incur, direct costs, overheads, depreciation. Depreciation is a non-cash expenditure, but seen as a cash outflow. Bank loan, interest paid, principal repayment, investment, dividend. Other than revenue, everything is negative. This is cash inflow. All others are cash outflows. If you have maybe investment has given you interest, the interest is cash inflow. So this is positive, this is positive, this is negative. Okay. Revenue is proceeds from the sale of goods and services. Charges for services and products sold but yet to be paid will be included in accrual account receivable. Let's say you have issued an invoice to the customer, but the customer has not paid yet. That will be an account receivable. Once the customer pays, it becomes your cash in the bank. Right. So how much cash you received, how much cash you received in a year, how much cash you received in a year, cash is physical. Account receivable is paper money, invoice. You have only raised an invoice, you have not yet got the cash. The cash is the physical cash plus account receivable at the start of the year plus the sales made in a year minus cash received from the customers is equal to account receivable at the end of the year. Right? Is equal to end of the year. If your annual sale was $2 million, your account receivable was $400,000 at the beginning of the year, and your account receivable at the end of the year, remember from the balance sheet, from the income statement and the balance sheet, you see that this was the AR for the previous year. This is the AR end of the year. How much cash you received is AR at the beginning of, remember, you want to calculate cash, right? So when you want to calculate the cash, it's sales minus, remember, you bring this here. So sales, all right, sales plus account receivable at the start of the year minus cash received. Minus cash received is the account receivable at the end of the year. We are just putting the numbers in the formula here. Plus $2 million minus X equal to $500,000. You need to calculate X. So take this X here and bring this here. The actual cash received is $1.9 million. Even though your sale was $2 million, your actual cost that you received, actual cash that you received is $1.9 million. $1.9 million. Direct costs are costs associated with the product and or services, similar to revenue. All right. It needs to be accrued because different suppliers will have different payment terms. So when the cash flow will be negative when you are paid the supplier. Otherwise, it will be account payable in your balance sheet. Overhead costs incurred by the organization, also known as indirect cost. Bank loan, remember you may have taken loan to fund your capital purchase or to fund your working capital. Once you have taken loan, you need to pay interest, and at the end of the loan period, you have to pay the principal amount. Dividends are payment made to the shareholder when they invest money in the company, again cash outflow. Depreciation is the cost of assets over a period of time. Remember, when you purchase, it is only applicable to capital assets, fixed assets. When you incur a expenditure of, let's say, $100,000 for purchase of an asset, and the asset has a useful life of, let's say, 10 years, and at the end of 10 years, there is no salvage value of the asset. That means when you sell the asset, you don't get any value of that asset. The salvage value, yeah, if dividend is reinvested, it goes into the general reserve. All right? It's not a cash outflow. Is there an item that can be both direct and indirect? It will depend upon the kind of industry. You change the industry, then it will become a different. Otherwise, for a given industry, a direct item is an item that is used in the making of that item. For example, if I'm making this pen, anything that goes into the making of the pen is a direct cost. Indirect cost is indirect cost. Right? So it cannot be that one item becomes indirect and direct. Depreciation is cost of asset minus salvage value divided by the useful life of the asset, $10,000. So if you are bought at $100,000, the book value of the asset reduces by $10,000 over the 10-year period. Don't forget that fixed assets have to be accounted for over multiple accounting period, whereas variable costs are accounted for within the same accounting period. Investment, remember, sometimes you may have some free cash. Like, for example, you have not given dividend, you have retained the dividend. What do? Should I let it remain in the bank, or I have told the shareholders that I'm retaining this dividend because I want to buy or acquire a company, or I need to invest in certain whatever opportunity. So that is investment. And if you have invested, you will be, it is current asset, and any cash that you receive will be your cash inflow. This is what we were talking about. This is your planned over the duration of the contract, and you're monitoring the dotted line is your actual cost. So you may sometime it may go beyond, sometime it may go below, but you have to make sure that at the end of it, your actual costs and the budgeted costs are same. Right? Otherwise, you'll have to end up seeking more budget. Or the management will say, how come you're left with so much money? You must have over budgeted. As a result, some other function did not get the money because you took the money. So any variance has to be investigated and corrected. Dealing with variances, variance, like I said, is P times Q, right? This is the only variance, no other variance. Your price may have changed or your quantity is changed. Straight line, I'm using straight line depreciation method. Straight line depreciation method is, remember the one that I showed you, this is straight line depreciation method, cost of the asset minus salvage value divided by the useful life of the asset. Generally, maybe 5 years or what, that will be the depreciation value. So in my asset, I start with $100,000 every year. The book value of the asset drops by 10,000 and I take 10,000 as a expenditure in my income statement under depreciation. So price and quantity variance. How do I determine price variance? Price variance is budgeted price minus actual price multiplied by actual quantity. Remember, if price has changed, then I need to determine what was the variance in the price. So budgeted price minus actual price multiplied by actual quantity. Quantity variance, budgeted price multiplied by standard quantity, the quantity that I assumed when I prepared the budget, minus the actual quantity, that is the quantity variance. So you have price variance and you have quantity variance. The amount of variance, how much it varied is given by these two formulas. Right? These two formulas. So price variance is budgeted minus actual multiplied by actual quantity. Quantity variance is budgeted price multiplied by standard quantity minus actual quantity. Now, price variance can be positive, price variance can be negative. Whether it is positive or negative, you need to do a root cause analysis to find out why there was a variance. Right? Why there was a variance? Because that question will be asked by the management also. Why is there a variance? Maybe you did not budget correctly. Right? Or maybe external factors. Right? Maybe external factors. Labor variance is the difference between budgeted wage and the actual wage. How much money you paid the worker, budget, because budget is prepared in the beginning of the year, and how much money you are actually paying to the labor. It will depend upon the labor market condition. If the labor market condition is very good, you may have to pay higher wages to retain your people, otherwise your people will leave the company. Right? Or if the economy is not good, probably you have retrenched people. So your labor cost will be lower. But you still have to determine why there was a variance. Similarly, overhead variance, differences between budgeted cost and one of the reason could be due to quality. The specification that you wanted, all right, total wages, including any incentive or overtime. Remember, one of the reason for variance in the price could be change in quality. Right? Change in quality. Maybe when you were planning, you had a certain requirement, but if the change in quality is because of poor performance of the supplier, then you have KPIs to protect your interest. Right? If you are not doing that and you're ending up with receiving poor quality item, then your cost of operation will increase. Right? Don't forget that the price that you're getting, this price that you're getting is based on quality, quantity, time, place in the specification. Then you got this price. This budgeted price is this one. If the supplier changes the quality, then you have performance measurement systems to take care of that. This should not change here because quality has changed. You don't want to change the quality. Clear? So quality is not acceptable anyway, but price may change because of inflation or because of demand and supply condition or market structure, economy, interest rate, many reasons for price to change independent of quality. So don't mix up the quality. If quality is not been met, then you have the performance management systems to take care, or the contract to take care.